welcome. You're tuned into the Small and Mid-Cap Show. I'm Hiral Dadia. Let's quickly take a look at what the markets are doing at this hour after the kind of sell-off that we've seen in terms of yesterday's session. Overall, if you go to see, we were below the 21,159 mark. Did a little bit of an up move, came back into the green, but we are pretty much on the borderline as we speak, but a good recovery from the day's lowest levels as we speak. We've hit a high of 21,166. The advance decline ratio, which was absolutely favoring the declines on opening, has now turned in favor of the advances. So let's see how the close happens in today's session, because these 2 days are going to be absolutely interesting for the traders as well. And it is the weekly F&O expiry. Overall, if you see in terms of Bank Nifty as well, 100 points cut, but a recovery coming in from the day's low of 46,919. So good up move on that front, and the advance decline ratio is absolutely equal. 6 advances as well as 6 declines in terms of Bank Nifty. Let's pull up the mid cap as well as the small cap index, because yesterday the cuts were absolutely deep. Almost 3.5% was the kind of cuts that we saw. Today a recovery, 0.9% higher on the mid cap and a little over 1.1%. We're trading at the day's highest levels on both these indices. Let's look at stock specific action as well. If you see in terms of the large cap space, Power Grid, the top gainer in today's session. LTI Mindtree seeing some smart moves. UPL, Apollo Hospitals, as well as the HDFC Bank. So strong moves coming in these names in today's session. On the losing end, Axis Bank continues the downward spiral. L&T is down in trade. SBI Life, Bajaj Auto, as well as the L&T, which are trading under pressure. Let's look at broader markets as well. What stocks are in the limelight today? Because clearly, you have HPL Power, which is up almost 9.5 to 10%. Shyam Metallics is seeing some strong moves. Kiri Industries is another one. Sonata is another one that we are looking at as well. Indian Bank is trading under pressure, 4.5%. The QIP shares actually start trading on the bourses today, and that stock is trading down. CUB is down 3.5%. Loda, which is macro tech developers, is under pressure. In terms of newsmakers as well, a lot of them that we have been watching out for. Z Entertainment, that's one which saw a strong move in today's session. Cochin Shipyard as well as Mazgon Dock, both these counters were up in trade, and this was on the back of an order win. On the back of acquisitions as well, we've seen some of the stocks that have been in focus, but clearly a day of stock specific action, some bit of recovery that's coming in terms of broader markets as well, and whether this is going to be sustainable and will we see a close in the positive is what we need to wait and watch. But let's move across to one company that has been in focus, Teamlease. Now, staffing headwinds have been there, specifically when IT as a sector is concerned. Let's actually understand what is happening in the hiring space in India and what it would mean for a company like Teamlease. The stock is seeing gains of 0.8%. Ramani Dathi, CFO at Teamlease, joins in. Ramani, good morning and welcome to the show.
Good morning, Hiral. Thank you.
Ramani, overall, if you go to see, there were headwinds that we were seeing at least at the end of the second quarter. And that's what the management indicated as well during the earnings call. What's the sense that you're picking up now if you have to look at the various services from general, IT, telecom, as well as if you talk about the apprenticeships?
As far as general staffing is concerned, right now all industry segments are on very good hiring spree. So be it BFSI, consumer verticals, FMCG, FMCD, pharma, telecom. So across all the segments, we are seeing very good growth numbers. Specific to Q3, this festive season is a little below our expectation, and also on BFSI front because of RBI cautions on unsecured loans and riskier credits. So we are seeing a little lower side of the hiring, but barring this specific quarter for the Q4, next quarter as well as H1 of this year, we have seen good momentum in hiring across sectors. Specialized staffing, IT headwinds will continue. As of now, there are no green shoots as far as IT services are concerned, but GCCs, the captives, have started hiring. So that's a good indication. And in terms of apprenticeship business, so we have completely let go the NEEM headcount, which is close to 40,000, and now we are adding headcount on the rest of the business on apprenticeship sequentially. So overall, except for IT right now, rest all industry segments are adding numbers on hiring front.
Right. So good hiring coming in except IT. Looking at the way IT is, the reason I want to take that conversation forward is last couple of trading sessions, or if you see the month as well, IT as a sector has been strong in terms of stock performance. Accenture reported numbers, and what they have indicated so far as well, that yes, there could be muted moves. The order wins, the deal wins are slightly lower, but they've not retraced from their guidance that they've given for the full year. Now, what is it that you're hearing? Are you seeing some bit of recovery that could come in the fourth quarter of FY24, or do you think it's still some time away to see that recovery, which could then translate into revenues for a Teamlease?
Yeah. It's little early to comment on that because, as you have rightly mentioned, many of these IT services companies have already reached the peak of their employee utilization, and they haven't been hiring at least for last 5-6 quarters. So they cannot keep the hiring on hold for such a long time. So we also believe that maybe in the next 1 or 2 quarters, there should be some pickup in the hiring in Indian IT services as well, along with the GCCs. But I think we have to see the Jan-Feb trend before we comment on whether there are any green shoots happening on hiring front.
Right. Overall, if you see from a margin perspective, how is that looking like for the general staffing business, taking into consideration it's going to be a minor blip in the third quarter, but overall is looking good. So if you have to look at third quarter as well as the second half of FY24, what is that indicating?
As far as general staffing business is concerned, our margin expansion mainly comes from operating leverage. And as we have indicated, we are not adding any costs in the back end. The fixed costs are fully absorbed, and the entire growth in top line ideally flows into the bottom line. So with that, we are confident of expanding the margin sequentially by 5-6 basis points within general staffing business. And at group level, with contribution coming from HR services and other high margin verticals, so we'll sequentially grow margins from here onwards.
Okay. And so if you're saying sequential growth, do you think then the fourth quarter of FY24 probably will be the best quarter in terms of the year, and Q3 could be one of the muted ones out of the 4 quarters?
No, even Q3 we are having growth. So it's little below our expectation, but still on a sequential basis, there is a decent growth on what we have indicated. And as you have rightly mentioned, Q4 will be the highest contributor for us in terms of profits and margin expansion this year.
Okay. And how do you plan to tackle the entire concern with the IT sector? Do you think, because there is uncertainty on that front, you will ramp up segments other than IT from here on?
See, for us, IT services used to give us almost 70% contribution in our specialized staffing business. And ever since the headwinds have started, we focused on growing IT for non-IT companies, because now for many non-IT companies are also investing and expanding their tech teams for their digital transformation and other technology-related initiatives. So we have focused and built that as a new segment. And GCCs, GBCs, product companies, captives. So these segments also we have focused. So now the contribution from non-IT service companies have increased from 30% to 50% in the last 1 year. And maybe going forward, we can also build other verticals like finance, legal, HR profiles, because these are the profiles which many GBCs are looking for.
Okay. And where is the demand coming from?
Yeah. Except for IT services, so there is a good amount of demand in terms of hiring is concerned. So we have recently released an employment outlook report as well. So there we have mentioned that the top 3 cities where we are seeing the maximum demand is Bangalore, Chennai and Bombay. And now even the tier 2 cities have started picking up on hiring front, especially cities like Coimbatore, Nagpur, Indore, Chandigarh. We are seeing good expansion, especially on retail and consumer verticals. BFSI has been one of our major growth drivers for the last 4-5 quarters, and it will continue to give us good numbers in tier 2, tier 3 places as well.
Okay. So what's the growth that you're looking at if you have to look at FY24, and what's the next milestone you think you will be watching out for?
We will be maintaining a top line growth of upwards of 20% and consistently expand margins sequentially. I cannot give an exact guidance as such on the margin front, but we are very clear that there will be a consistent growth on profits for the next few quarters.
Okay. And one more question I have with you is specifically with regards to where consumption and retail as a sector is concerned. What's the sense that you're picking up on that front? Are you seeing any trends which do indicate a slowdown, or are you seeing an upbeat mood on that front?
No, on retail, in fact, we are seeing very good growth. As I mentioned, now we are hiring more people for retail in tier 2, tier 3 places, the smaller cities and towns. And there the hiring numbers are very good for as far as retail is concerned. FMCG for this quarter is, for the festive season, is below our expectation, but the kind of open positions that we have for next 2 quarters, both in FMCG are very good. So we are not seeing any sort of slowdown as far as contract hiring is concerned, temp staffing is concerned.
Right. So these are going to be interesting trends we will be watching out for as well. Thank you, Ramani, so much for joining us on the show and sharing the views. So that's with regards to where Teamlease goes. A lot of positive factors, but IT still continues to be a matter of concern, where the company gets 70% of its revenues. If you pull up a long-term chart of a Teamlease as well, if you see a 1 year, that will give you an indication of what has happened. There you go, 13 to 13.5%, but that recovery that has started to come in the month of November, December, let's see how sustainable that is going to be with regards to where Teamlease goes. But let's quickly slip onto a short break. On the other side, we will bring you the management as well of other companies of Greenpanel that will be in focus, a company which is a clear proxy play on the rising real estate sales and their capacity expansion plans. Please stay tuned. Welcome back. You're watching the Small and Mid Cap Show. Let's shift focus to Greenpanel Industries, a company which is a clear proxy play on the rising real estate sales in India And the expansion of capacity is one of the key triggers we have been watching out for. In the last 9 months, 26 to 27% is the kind of up move that we've seen in terms of the stock price as well. Let's see if this rally does continue. To discuss more and understand the strategy going forward, Vishwanathan Venkatramani, CFO at Greenpanel, joins in. Welcome to the show, Mr. Venkatramani.
Yeah, good morning.
My first question coming to you is overall, with the kind of up move and the pre-sales numbers that are trickling in from real estate players, it seems that you do become one of the key beneficiaries of that up move as well. What's the outlook looking like?
See, the medium and long-term outlook definitely looks good, but the current atmosphere, has been to some extent dampened by imports increasing significantly over the past financial year. So imports compared to last year have gone up by about 3x, and that has impacted growth of our volumes. We will possibly be going by about 6 to 8% this quarter, but I think those numbers would have been much better if not for the significant increase in imports.
So what's the reason for this significant increase in imports? Because, there was a point in time we were talking about imports reducing and a lot of Indian companies actually becoming a proxy pay directly. What's happening?
Okay, so most of the imports are coming from Vietnam and Thailand, and those countries were originally manufacturing furniture for exports to US and Europe. With the current slowdown in those geographies, they have started dumping MDF into India and the Middle East, at very low prices, which are about 18 to 20% lower as compared to domestic prices. And that has impacted growth in our volumes. Our dealer network is still insulated, because they typically focus on large customers. But yes, our OEM customer base has been impacted.
Okay. And what happens then with regards to your capacity expansion plans? Because already in terms of FY25, you had a plan where capacity would come on board. Do you think anything changes on that front because of the increased imports?
No, our capacity will be online sometime in Q3 next year. And we are currently operating around 75 to 80%, and we hope to reach somewhere between 90 to 95% next year from the existing capacity. And the new capacity will be focused on, primarily thin MDF boards with thickness between 1.5 to 5.5 millimeters, for which there is already a significant market in India.
Okay.
So I think we'll have a ready market for the new capacity right from day one.
Right. Another counter argument I have over here with you is, though the imports have gone up 3 times, there is another conversation that everyone is watching out for, wherein plywood is expected to be substituted by MDF, and the next 3 to 5 years then are expected to be really strong for the MDF players. How would you place this? Because clearly then this would translate into a stronger volume growth.
Yeah, definitely. So I would say it's linked to 2 factors. If you look at the plywood segment, there are 3 broad segments in the plywood industry: the premium segment, the mid segment, and the cheap plywood segment. The cheap plywood segment is currently being replaced by MDF, and over the medium term, the mid segment is also expected to be replaced by plywood. And another development which we are looking out for is we are expecting major changes in the furniture industry. Today, the furniture industry is, largely unorganized. Almost 75-80% is with the unorganized segment. And the government is also thinking in terms of a PLI scheme for the furniture industry. I think when that happens, we will see a large number of, organized domestic and international players entering the furniture industry, which will lead to rapid automation of the furniture industry. And when that happens, MDF is expected to be the key raw material for furniture manufacturing, because most of the plywood manufactured in India would not be a suitable raw material for these automated furniture manufacturing plants.
Right. So with this, how much is the peak potential revenue from the new plant that you're looking at, number one, from the time it is commissioned, and two, with regards to the existing plant in terms of Andhra Pradesh? We know due to issues that, because of natural weather conditions, there was a stoppage. Now that it has resumed operations, what's the kind of impact you've seen?
It was very nominal impact. Operations were hampered for just 2 days. So nothing significant there. And yes, I think, we are looking to achieve optimum capacity utilization in the Andhra plant sometime in the next fiscal.
And how much potential revenue you think it will give you at its peak?
Okay, the new capacity, so there are two, estimates which could be dependent on, the mix of domestic and exports, and also the mix of value-added products. Today, at our existing capacities spread across Uttarakhand and Andhra Pradesh, about 55-56% of our domestic volumes comes from value-added products. So I think in the beginning, possibly, at optimum capacity utilization, we will be targeting revenues of around 650 to 675 crores. And once value-added products reach the current percentages, we will be looking at a revenue of about 750 to 775 crores from the new capacity.
Got it. Another question I have is, with this expansion, the company will actually complete its major capex cycle, and if that's going to be the situation, how does it impact the cash flows, say, after this? And secondly, does it mean improved cash flows leading to a probably increased dividend payout for the shareholders as well?
See, cash flows have been robust, because we are a company primarily focused on cash flows. So cash flows have been good, and we expect those to be robust over the next 2 years. So we are primarily waiting for the new project to, get completed before we take a decision on the surplus cash flows.
Okay, but do you think from where it stands, it will be further enhanced, and that is something which will benefit shareholders?
Yeah, definitely, I would look forward to that.
Right, and what is the kind of return ratio profiles that you're looking at, lastly?
I think we normally target an ROC of around 22%, from any new project.
Right. So I think strong growth that could be on the annual as well, and by the time the capacity comes at play for a green panel, clearly there is scope for expansion in terms of sales as well. Thank you so much for joining us on the show and sharing the views. So that's the management of Greenpanel Industries. Clearly, yes, there is concern with regards to where imports go, because the imports have gone up 3 times, but the demand is absolutely strong with that replacement happening from the plywood industry as well. But moving on, another stock, that is BEML, that is in focus. My colleague Neeraj Shah spoke to BEML's CMD Shantanu Roy about their double-digit EBITDA growth last year and how they plan to replicate the same this year. Let's listen into a slice of that conversation.
What I can say is that, yes, last year we had almost touched double digits as far as our EBITDA is concerned. And this year, I'm pretty sure that we will touch the double digits, and we may even grow the EBITDA by around 200 basis points. Whether it will reach the late teens or not, that's for the future to see. But one thing I can say is that we are in a very competitive environment, competitive segment. And being a manufacturing company in the capital goods industry, normally where the margins are, around 7 to 8%.
Right.
Even if I get an EBITDA of around somewhere around 12 to 14%, I'll be very happy. But beyond that will be really, very difficult.
Got it.
The normal industry trend is not like that.
Also, I presume that if you're getting high margins, you would probably want to plow back that money into business to bag more orders as opposed to go in for higher margins.
Absolutely.
Okay.
Absolutely.
Okay, but still, from nearly touching double digits to whatever number you reach, let's say over the next 3 years, I heard you say that the order book, which is at 13,000 crores, God willing, would even touch 20 and maybe even higher, and maybe the long gestation projects in defense, etc., come into play. What's the revenue run rate, Mr. Roy, that you are envisaging? Because I think, again, some reports have that their estimate, maybe on conversations with you in your analyst day or otherwise, are of the opinion that you could maybe even do a 20% CAGR over the next 3, 4, 5 years.
That is what our plan is. This year, especially, we have the orders. Now we have to convert those orders into the sales revenue, and we are focusing fully on execution. Similarly, if all goes well, then we would like to grow at around 20% per year. And once we are able to do that, then when we reach a level which I would call escape velocity, then there will not be any looking back.
So EBITDA margin, double-digit growth on that one is what they are aiming for, and 20% growth is what the management of BEML is looking out for. But completely out of time. That's all that we have on this edition of the Small and Mid Cap Show. Lots more lined up on the other side. Please stay tuned to NDTV Profit.